Hi, Greg Black again. In this segment, we're going to talk about the myths of investing. But before we do that, I want to take some time to thank all those that posted some comments and asked questions about the last course. It's very rewarding. We put a lot of time and energy into this course, and I'm really happy to see that a lot of you have found it to be interesting. Now, if you haven't posted any questions, or please feel free to do so that I can personally get back to you and answer those questions. Last time in our course, we discussed what people want to know, and I gave some examples of the typical responses that I hear when I talk to investors. First of all, I'm often told by investors that, Greg, I would like to have an active retirement, or I don't have to spend a whole lot of time worrying. I did plenty of worrying during my life when I was working, and now that I'm retired, I want to focus on spending quality time with those that I love, and not be so constantly concerned about what the market's doing. I also have people say that they want to have confidence that whatever obstacles are thrown their way, whether it's inflation, market performance, that they have a strategy designed to address those concerns. They also want to be involved, but they do not want to have to be involved on a daily basis or to track what happened in the market each hour, watch the news, in order to have peace of mind. Lastly, they want to make sure that they can protect themselves against unscrupulous advice. We all know about the many Ponzi schemes and Bernie Madoff, and quite frankly, he was able to scheme a lot of smart and very sophisticated people. And the people that I talk to want to make sure that they don't ever get crossed with anything like that. So, this is what I'm very often hearing. One of the first things that we spend time working on with our clients after they complete the 20 must-answer questions, like we mentioned in our last course, is that we want to get into the myths. And that is the first thing that I want to help you determine, is if you have been victimized by any of these myths. Have you been hurt in some way? Let's take a look at these myths. And the first one is selective stock picking. Now this is a myth that is very pervasive. And that myth is all about somebody, whether that's Jim Cramer, your brother-in-law, portfolio manager, who knows? But it's that they know what stocks are going to go up and which ones are going to go down ahead of time. They want you to believe that somehow they have knowledge that nobody else has. Now, let me tell you this. If they do have knowledge that nobody else knows about, it might be worth listening to. Except that you could go to jail. If they were talking about operating within the legal confines, then reality is that everything we know is already factored into the stock price today. If what we don't know, it's what we don't know about the future of companies that determines their stock movement. Which is why on average 80% of all professional fund managers fail to beat the index benchmark that they have set for themselves. So for example, 80% of the large stock portfolio managers usually produce a return lower than the market as a whole. And that 20% that are successful tends to be a different group each and every year. In other words, they don't replicate. Which would lead one to believe that it merely has to do with skill, or more with luck than with skill. I'll tell you this, that much studies have been done to show this to be true, that it is more luck than skill. That you have a better chance of beating market averages by throwing darts at a board than you do by relying on a stock picking strategy. The second myth has to do with markets themselves. The myth is that somehow markets are predictable and that we can therefore make changes to our portfolio before the rest of the world figures it out. But in truth, markets respond to news, and news, last time I checked, continues to be unpredictable. A few years ago, there was a great TV show about a guy that would get tomorrow's newspaper delivered to him today. And he used that information to create a lot of riches at first. Then he used it to create a lot of good. Now, in that TV show, that would have been very nice to have. But look, the news is always going to be unpredictable. But what we do know is that over time, good news does outlast bad news. Just through the course of my lifetime, we've had plenty of economic news, plenty of bad political news, and yet through all of that, the markets continue to go up. News is unpredictable, and market timers who want you to believe that they know what is going to happen in the news are either naive or they're lying to you, and you need to decide which is which. The third myth that we're going to get into is the fact that there are some people who have had some very good success outguessing the market. And therefore, they're going to want you to believe that because they called it in 2008 or they called it right last year, that somehow that's a good indication of what they're going to be doing in the future. Very often people say to me, Greg, you're always saying that markets can't be successfully timed and stocks can't be selectively picked. And yet, I just read about this guy. How's that done? Well, that's easy to explain, and it's very simple. It's called the law of large numbers. Let me give you a great example. Imagine that if we're in a huge football stadium and we fill that stadium with portfolio managers and ask every single potential manager to stand up, reach into their pockets and pull out a coin. And we ask all those that get heads to remain standing and all those that get tails to sit down. Now on my go, I want you to flip that coin, and if they flip, those that get heads, again, stay standing, and those that get tails, sit down. Now, give me that situation with a stadium full of people, and the number of portfolio managers that are out there we have on Wall Street, with that many people trying, there's going to be some managers who get heads maybe 6, 7, maybe 8 times in a row. Now that's the law of large numbers. Does it mean they're expert coin flippers? Not necessarily. It's just skill or blind random luck, not necessarily skill. Now, the law of large numbers pretty much mandates that to be the case. I wouldn't even think twice about believing that there is somebody out there that would be able to flip 10 heads in a row. Expert coin flippers, no, I don't think so. It's just the fact that if you have enough people trying to do one thing, some are going to get it right. The fourth myth, and this gets into the fact that we are human, that we have emotions, that we do not behave in a logical fashion all the time. Frankly, that happens most of the time. The evidence that we see when it comes to investing is quite simply that we all know logically what we should do when prices are high and when prices are low, but quite frankly, we don't always do what we know we should do. In truth, we look at investor behavior and it's exactly the opposite. People who routinely put money into the equities market when they're at an all-time peak, and then they wait until the markets crash and at an all-time low to get the money out. It's very similar to, say, weight loss. We all know what we need to do to lose weight, and what we need to do is eat better and move more. But for some reason, we're unable to do that. Dieting is a multi-billion-dollar industry a year. Why? Simply put, we have inside ourselves a survival mechanism that tells us to avoid pain, seek pleasure. Where you can, but above all these, just avoid pain. It was very useful to our caveman ancestors. He knew how to keep warm and avoid predators and eat whatever he could, but in the civilized world, that strategy will make you quite heavy and probably shorten your life. It's the same thing when it comes to investing. We all know logically that markets go up and down. That gives us the opportunity to go out and buy more at a cheaper price, but it's painful watching our own investments drop when the market overall drops. So people panic. They convince themselves that somehow this time it's different and that the market's going to go all the way to the floor. Logically, they know that that's not going to happen, but emotionally, they can't take it anymore, and this becomes a problem. Very often, it's not the investments that we see that cause investors the most damage. It's their own behavior that hurts them. The fifth myth, one that gets to the fact that most people believe they can do this alone, that they can be their own coach to guide themselves through it. If you look at investor performance, it would indicate otherwise. In fact, investors would on their own typically make a lot of bad mistakes. So the information that's out there is not complicated to be a good investor. I'm going to share with you a lot of that over these courses. But what most people end up needing is someone to coach them and guide them through logical decisions and not being wrapped up in emotion. I always think of great athletes. They always had someone that observed them, and when they weren't performing at optimal levels, they were willing to have someone coach them through that. And more importantly, the greatest athletes were willing to be coached. We all have examples of great athletes that weren't willing to be coached, and as a result, they didn't have the same success on the field. Most of us act irrationally, and we don't always do the best things in our interest. A good coach will find those opportunities where we are acting inappropriately and acting against our own best interest and get us on the right track. Now, in the last course, I talked about what the number one obstacle that was preventing people from investment success. I'm going to give it to you here. Are you ready? Here it is. Now, what holds people back from realizing their dreams? Cost and its cost of investing. And most investing costs are hidden. Most people are unaware that they even have them. I've seen it time and time again. I'm embarrassed for my industry, quite frankly, when I hear that nobody discloses these fees. But they must be disclosed. And as an investor, you must be looking for that disclosure. What I'm going to do is to show you how you can observe what these costs are, because in many cases, you simply need to lower your costs and you will be able to increase that expected return without any additional risk. At the very least, you should know as a consumer what it is that you're paying. The solution is a worksheet that we've put together that you can see below the screen right here. It will allow you to put together an inventory of your holdings and begin to process and understand what it is and what they are doing and how much you are paying. How much are you really paying in investment management advice? The worksheet will show you how to find out where these sales charges are associated with your investments. And am I paying what's called a 12B1 fee? Well, what even is a 12B1 fee? This exercise will walk you through that, and so that you'll be able to be more aware of all of that. What is my turnover rate? Now, this is something very important. All these factors result in costs, and a lot of times they are hidden. A lot of times you don't see them in your statement. They're beneath the surface. You see them, in fact, and the way that you see them is by getting lower rates of return. And many things in life, perhaps automobiles, paying more for something actually means you're getting a higher quality. But it's not necessarily the case in the world of investing. In fact, I believe in more cases than not, the less expensive is actually better. You need to determine the total cost of what you're putting money into, whether that's personal funds or whether it's money that you have in your 401k plan. This exercise will help you determine just that. Again, I want to thank you, and especially those of you who are posting comments and questions. Keep in mind, as you do this exercise, if you should have any questions at all, post them below and in the comments section, and I will quickly get back to you. Now, in the next segment of this course, we're going to be covering 3 big things. I'm going to take you through some actual case studies, people we've actually worked with in the past, and problems they've had, and how we've been able to help them through this process. Second, we're going to talk about underperformance. We've been talking about costs up to now, and now we're going to get into the fact that most people are not getting the returns that they need. In fact, in a lot of cases, they don't even know what returns they need to get. Whatever they're investing is underperforming, and they are unaware of it. And lastly, we'll take you through the solution. We've been telling you a lot about the problems, and now we're going to tell you about how to fix it and how to go forward from here. Until then, do your homework, and we will look forward to talking to you in the next segment of this course.